UK-Adopted IFRS 16, Lease Accounting, the complete masterclass. Hello and welcome to CandiMentor. Today we decode UK-Adopted IFRS 16, the lease accounting standard used by UK-listed companies and groups applying UK-adopted international standards. Before we begin, please subscribe to CandiMentor. Audit. The purpose and scope of UK-Adopted IFRS 16. IFRS 16 replaced IAS 17 and changed how lessees report leases. Under UK-adopted IFRS, almost all leases appear on the balance sheet, except short-term leases and low-value assets. This shift reduces off-balance sheet financing and gives investors clearer visibility into long-term commitments. In the UK, auditors and the FRC expect strong documentation around lease terms, extension options, and discount rates. A useful summary statement is, IFRS 16 brings economic reality onto the balance sheet. What counts as a lease? The definition. A contract contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. Control means the customer decides how and for what purpose the asset is used. The identified asset must be explicitly or implicitly specified. In UK practice, assessment of substitution rights is a common audit focus. For example, a retailer leasing specific floor space in a London shopping centre usually meets the definition because the tenant controls use and benefits. End. Lessee accounting, the core model. At lease commencement, the lessee recognizes a right-of-use asset and a lease liability. The right-of-use asset represents the asset the lessee controls. The lease liability represents the obligation to make future lease payments. This dual recognition model applies to almost all leases except the two exemptions. Both items must reflect economic substance. Important phrase, the present value of future lease payments. The two lessee exemptions, short-term and low-value. Short-term leases last 12 months or less and have no purchase option. Low-value leases involve assets that are low in value when new, such as small office equipment. Entities may choose to expense these directly to profit or loss. In the UK, companies often apply these exemptions to printers and shared devices. The key is consistency in application. Measuring the lease liability, the initial calculation. Measure the lease liability at the present value of future lease payments. Include fixed payments, variable payments linked to an index, residual guarantees, and payments for extension options that are reasonably certain. Discount using either the rate implicit in the lease or the lessee's incremental borrowing rate, the IBR. UK companies often use group IBR curves supported by Treasury documentation. Example, a 3-year property lease with £10,000 annual payments and a 5% IBR has a present value slightly under £30,000 due to discounting. This. Measuring the right-of-use asset, the initial amount. The right-of-use asset includes the initial lease liability, lease payments made before commencement, initial direct costs, and estimated restoration or dilapidation costs. For example, £1,000 of legal fees for negotiating a Manchester office lease become part of the right-of-use asset. End. Subsequent measurement, depreciation and interest. After recognition, the right-of-use asset is depreciated, typically straight line, over the lease term. The lease liability unwinds using the effective interest method. Interest is higher at the beginning and decreases over the lease term, which front-loads finance costs. Journal flow, debit depreciation expense and credit accumulated depreciation. Then debit interest expense and credit lease liability. Simple UK example, office lease journal entries. Assume a 3-year UK office lease with £10,000 annual payments and a 5% discount rate. At recommencement, debit right-of-use asset for the present value, credit lease liability for the same amount. Each period, debit interest expense and credit lease liability, debit depreciation expense and credit accumulated depreciation. Reassessment and remeasurement, extension and termination options. Reassess lease term when events change certainty, such as extending the lease or reducing rented space. If the lease term changes, remeasure the lease liability using a revised discount rate. Adjust the right-of-use asset. UK regulators expect strong justification for extension assumptions. A frequent scenario is a London office with a break clause. Variable lease payments. Index or rate-driven variable payments linked to RPI or CPI are included in the lease liability only when the index changes. Use the index value at commencement initially. When the index updates, adjust the liability and the right-of-use asset prospectively. Index-linked uplifts are common in UK retail leases. Lease modifications. Increase, decrease, or scope change. A lease modification changes scope or consideration. If it adds a separate right-of-use asset priced at standalone value, treat it as a new lease. Otherwise, remeasure the existing lease and adjust the right-of-use asset. Example, adding another floor in an Edinburgh office typically requires remeasurement. Lease and non-lease components. UK practical expedient property. Leases often include service charges, maintenance, or insurance. Identify non-lease components unless the entity elects the practical expedient to combine them. If combined, all payments are included in the lease liability. Many UK groups elect this expedient for simplicity. Sale-and-leaseback, a high-risk UK area. For a sale-and-leaseback, first assess whether a sale occurs under IFRS 15. If a sale occurs, recognize only the gain related to rights transferred. Record the lease liability and right-of-use asset for the retained rights. Sale-and-leaseback is common in UK retail and logistics. Regulators pay close attention to the disclosures because these transactions influence leverage metrics. Disclosures. UK regulatory focus. Disclosures must show maturity of lease liabilities, expenses for exemptions, variable payments, breakdown of right-of-use assets, discount rates used, and judgments around extension and termination options. The FRC often challenges poor disclosure quality. Good disclosures highlight economic reality. Industry scenarios. UK-specific examples. Retailers lease shops across the country, often with extension options and indexation. Logistics companies lease vans and face residual value risks. Telecom operators lease network sites with significant non-lease components. Construction firms lease heavy equipment, where substitution rights matter. Professional firms lease office floors with material restoration costs. Industry context shapes lease terms, discount rates, and marketing strategies. And variable payment treatment. Journal entry quick reference. Initial recognition. Full debit, right-of-use asset. Credit, lease liability. Interest unwinding. Full debit, interest expense. Credit, lease liability. Lease payment. Full debit, lease liability. Credit, cash. Depreciation. Full debit, depreciation expense. Credit, accumulated depreciation. Remeasurement due to extension. Full debit, right-of-use asset. Credit, lease liability. Reverse the entry if the scope decreases. End. Practical interview and learning tips. Begin with the core model. IFRS 16 recognizes a right-of-use asset and a lease liability. Highlight discount rate judgments because UK auditors focus on them. Discuss extension options and break clauses. Use a small numerical example to demonstrate clarity. Always consider what disclosures look like for a UK-listed company. Final rep. Always connect your explanation back to the essentials of UK-Adopted IFRS 16. Identify the lease, measure the liability at present value, recognize the right-of-use asset, unwind interest, depreciate the asset, and reassess assumptions when facts change. If you learned something today, subscribe to CandiMentor. We are building the world's best learning hub for accounting and finance, and you should be part of it.